Welcome back to Investing Talk Podcast. Hey there, and thanks for joining us again. We're here to cut through the noise and give you the insights you need. Today, we're taking a close look at a company that's been making some waves, IREN. And the big question, one we really want to tackle for you is IREN a good time to buy now? We're going to, pull this apart from all angles, financials, market position, what the future might hold. Basically, we're aiming to unpack a full assessment and just highlight what really matters for your decision. Before we jump right into IREN, though, if you find this stuff helpful, please do hit subscribe, maybe give us a like or drop a comment. It really helps us keep doing this. And hey, if you're feeling extra supportive, you could even buy us a coffee. We definitely appreciate it. Oh, and one more thing, if there's a specific company you want us to examine next time, just let us know in the comments below. We'll add it to the list. All right, let's get into IREN. So setting the stage, IREN, they're in the integrated data center sector. But the really interesting part, for me at least, is their focus. Data centers powered by renewable energy. That feels, well, significant.
Oh, absolutely. It's more than just a detail.
Yeah.
The compelling thing here is IREN's position. They're sitting right where two huge trends meet. You've got the massive shift to green energy, right? The energy transition. And then there's this just relentless demand for sustainable computing power. Think AI, cloud, all that stuff. IREN isn't just in the market. They're building for that intersection. It really positions them strategically for the long haul.
That's a really strong narrative, powerful stuff. But, investors need more than just a good story. They need numbers. So when we look at IREN's financials, wow, that revenue growth jumps right out. For 2024, they hit $188.76 million. That's up 150% from about $75.5 million in 2023. I mean, 150% in 1 year. That's pretty remarkable momentum.
It really is a standout number, no question. But we need context, right? The company is still unprofitable. Their trailing 12 months net loss was around $35.67 million.
Yeah.
That's an EPS of negative $0.18. Okay, but here's the kicker, especially for a growth play like this. Those losses, they actually dropped by 83% compared to the year before.
83%? Okay, that's significant.
Exactly. In this kind of capital-heavy, high-growth area, that signals they might be getting way more efficient, maybe getting closer to profitability faster than people think. It suggests they could start funding their own growth soon, which, makes their big plans seem a lot less risky.
Yeah, that huge drop in losses definitely changes the picture on their path to profit. And their balance sheet looks, well, pretty solid, too. Total equity is around $1.1 billion, and total assets about $1.15 billion. Those are substantial numbers.
They are. Shows a strong asset base that's growing. And importantly, their leverage is quite mild, about 1.1. Plus, and this is critical, they have a lot of cash. $404.6 million in cash and short-term investments.
Wow, over $400 million.
Yeah, that gives them tons of flexibility, not just for day-to-day stuff, but for serious expansion. Building these advanced data centers costs a fortune, so having that kind of cash cushion is a huge advantage. So for you, the listener, the question is, how much faster can they grow with that kind of war chest?
That cash position is definitely a key strategic point.
Okay, so fundamentals. Strong revenue growth, improving losses, solid balance sheet, lots of cash. Now, how does the market see all this? Let's talk valuation. The price-to-sales ratio, the PS, is pretty high, around 72.12. What does a number like that really tell you, the listener?
Well, 72 is,
Up here.
yeah, it's definitely up there. It's a very clear sign the market isn't valuing them on current sales. It means investors are pricing in massive future growth. They're paying a premium because they expect huge things down the line. You often see this with potential disruptors.
Right, betting on the future potential. What about price to book? How does the market value their actual assets?
The PB ratio is around 2.8. Now, given their billion-dollar equity base, that's actually quite reasonable for a growth company. It's still higher than, say, a mature value stock, but it again reflects that optimism. Investors see value there. And what are the analysts saying? Seems like they share some of that optimism, but maybe a bit more cautiously. The consensus price target is $19.22. That's, well, only about a 5.9% upside from where the stock's been trading recently.
That's right. And this is where it gets interesting, a bit more nuanced. While the overall analyst view is positive, you do see some forecasts predicting a pullback in the near term, maybe down to around $16.
$16. Why the caution?
Mostly due to the stock's volatility. High growth names like this can swing wildly based on sentiment or market shifts. It's just a good reminder that even with a strong story, the short term can be bumpy. You need to consider different viewpoints when thinking about entry points.
Good point. Timing is always tricky with volatile stocks.
Okay, let's pivot to the stock's actual behavior, the technicals. We've seen a big surge in the price recently, right? And trading volume spiked like crazy, up 184%. That definitely screams strong investor interest, doesn't it? Momentum. Oh, absolutely. That volume spike with the price move, classic bullish sign, shows real conviction. And looking deeper, the stock's trading well above its key moving averages. It's above the 50-day, which is around $11.44, and the 200-day near $9.99. That reinforces the bullish trend.
Okay.
What's also interesting, though, is the RSI, the Relative Strength Index. It's hovering near 50, kind of neutral.
So not overbought.
Exactly. It suggests that despite the run-up, it might not be totally exhausted yet. There could still be room to run before it gets technically stretched.
That sounds promising, but let's talk about that volatility again. The beta is 3.99. For our listeners, explain what a beta that high actually means.
Yeah, a beta near 4 is really high. Basically, it means IREN's stock price is expected to be almost 4 times as volatile as the overall market. So if the S&P 500 moves 1%, IREN could potentially swing 4%, either up or down.
Wow, big swings.
Huge swings. It's pretty typical for companies in these cutting-edge, disruptive sectors. Lots of hope, lots of uncertainty, means big reactions. So the technical picture. Strong uptrend, yes. But it comes with a big warning label. High volatility. So you really have to ask yourself, how much of a roller coaster are you willing to ride?
Right. Risk tolerance is absolutely key here. Okay, so what's actually driving all this activity? Let's look at news, sentiment, catalysts. Those recent news about a strategic partnership, wasn't there, with a major tech firm focused on energy solutions. How important is something like that?
Oh, partnerships like that can be incredibly important. It's not just about the tech. First, it validates IREN's approach, having a big player sign on. Second, it can open doors, new trinkets, shared R&D, maybe access to the partner's customer base. It can really accelerate their growth and cement their position as a leader. It's potentially a huge boost.
Makes sense. Validation and acceleration. Now, sentiment. Analysts seem really positive, 10 strong buy ratings. But then you look elsewhere. Social media seems mixed, and the fear and greed index is leaning towards fear, even with the stock price doing well. How do we square that?
Yeah, it's a great example of how different sentiment measures capture different things. Analysts are usually taking a longer-term fundamental view. Their models look out months or years.
Okay.
Social media, that's often instant reaction. Short-term news, emotion, general market jitters. And the fear and greed index reflects broad market psychology, which might be nervous even if one stock is hot. So you get these contrasting signals. For you, the listener, it means thinking about which time scale matters most for your investment.
Interesting. It really paints a complex picture of market mood. Looking ahead, what catalysts should we keep an eye on? The next earnings report is August 27, 2025, right? That sounds key.
Absolutely pivotal. That report should give us a much clearer view on their path to actually making money consistently. Beyond that specific date, though, the bigger catalyst is just the ongoing massive demand for what they do, those renewable power data centers. That underlying industry growth provides a really strong long-term tailwind for them.
Got it. So specific updates like earnings, but also that broader industry trend. We've talked a lot about the upside. Let's make sure we cover the risks too. What are the main company-specific dangers investors need to watch out for?
Well, number one is still that unprofitability. Yes, losses are shrinking, but there's still losses. If growth slows down unexpectedly or if costs get out of control, that very high valuation we talked about could become a big problem fast.
Right, the market's priced for perfection almost.
Pretty much. Any stumble can hurt the stock significantly.
And what about risks specific to their sectors, data centers and renewables?
Yeah, both areas are pretty sensitive to regulations. Changes in environmental rules, energy grid policies, even data privacy laws could impact their costs or business model. And technology moves fast here. There's always a risk that some new innovation makes their current approach less competitive. They need to keep investing and adapting.
Makes sense. And then there are the macro risks, that super high beta. How vulnerable does that make IREN to just general market downturns?
Yeah, extremely vulnerable. A beta near 4 means if the whole market catches a cold, IREN could get pneumonia.
Okay, maybe not the best analogy, but I get it.
Right. Market corrections, rising interest rates, making borrowing more expensive. These broad factors can hit high beta growth stocks like IREN disproportionately hard.
And you mentioned the high trading volume means good liquidity, but also big swings.
Yeah.
What's the specific risk for short-term traders there?
It means you can get in and out easily, sure. But the price can move against you very, very quickly. That volatility creates opportunity, but it demands serious discipline. You could lose a chunk of capital fast if you're not careful. It really forces you to consider how much risk, financially and emotionally, are you truly prepared for? with those big, rapid moves.
A critical question indeed. Okay, let's pull it all together. Our final assessment for iron lands at a 7 out of 10. Can you walk us through the thinking behind that rating?
Sure. A 7 reflects that balance between the really exciting potential and the significant risks. The positives: amazing revenue growth, great strategic positioning in a booming field, improving financials, that strong cash position.
Mm-hmm.
Those are all big ticks.
Mm-hmm.
The negatives:
Mm-hmm.
that high valuation and the extreme volatility. Those temper the enthusiasm a bit. So it makes iron a better fit for someone with a higher tolerance for risk, someone looking for growth, not necessarily stability.
And if someone is considering buying, what's a sensible entry range given the volatility?
We'd suggest looking at the $16 to $17.50 range.
Okay, why that specific range?
It's based around recent support levels, and it's consciously below the recent peaks. The idea is to try and buffer against some of that short-term chop, give you a slightly better starting point if the stock does pull back a bit, as some forecasts suggest.
Got it. A bit more conservative entry. And what about time frame? Is this more of a long-term hold or a short-term play?
Definitely leans towards long-term. Given the growth story and the fact they're still working towards consistent profit, you likely need time for that to fully unfold. Short-term traders can play the momentum, absolutely, but because of that volatility, they need super strict risk management.
Speaking of risk management, any specific guidance for those short-term traders, like a stop-loss level?
Yeah, for traders looking at it now, setting a stop loss around $15.50 seems prudent. That helps protect your capital if the recent volatility leads to a sharp downward move. Discipline is key.
Okay, $15.50 for a stop. And what about taking profits on the upside, short-term?
For short-term targets, aiming for the $19 to $20 zone makes sense. That lines up pretty well with analyst targets and areas where the stock might hit resistance. It's all about trying to capture some upside while actively managing that downside risk.
Balancing opportunity and protection. Makes sense. So wrapping it up, the main takeaway on iron is it's a really compelling growth story, right? Boosted by its unique spot in renewable power data centers, strong financials, improving picture.
Exactly. A lot to like. But that high valuation and high volatility mean it's not for everyone. It really suits investors who are comfortable with more risk and have a longer time frame, ideally, to let the growth play out. Short-term plays are possible, but require serious caution and discipline.
Right. So as you think about all this, here's a final thought for you, the listener, to mull over. How do your specific investment goals, and perhaps more importantly, your personal comfort level with risk, match up with a company like IREN, a company offering that potential for high growth, but also bringing significant swings along for the ride? Something to consider as you plan your next move. Thanks for tuning in.